Have you ever looked at your portfolio after months of saving, expecting to see a massive leap in your wealth, only to realize you've barely made a dent? Most people quit investing when they don't see immediate results, jumping from hot stocks to crypto in a desperate search for fast money. We live in a world of instant gratification, where we want our investments to double overnight, and when they don't, we panic. We think the system is broken, or worse, that we just aren't cut out for building wealth. But what if I told you that the people who actually build lasting generational wealth aren't doing anything exciting at all? The quiet millionaires simply follow something called the 7-5-3-1 rule. Welcome back to the channel. Today, we are breaking down the 7-5-3-1 rule, a boring, highly structured psychological framework that guarantees you survive the initial years of disappointing growth to reach what we call the explosion phase. If you are tired of checking your portfolio every single day, letting the stress of the market dictate your mood, and feeling like you are always one step behind the latest trend, this video is exactly what you need. Grab a cup of coffee, settle in, and let's talk about building a durable wealth-building system that relies on simple mechanics and math rather than motivation, discipline, or market timing. Let's dive right into the very first number in our framework. The 7. The 7 stands for a minimum time horizon of 7 years. Now, why 7 years? In the investing world, short-term thinking is the absolute destroyer of wealth. When you invest money that you might need next month or even next year, you aren't actually investing, you're gambling. The stock market is incredibly volatile in the short term. Over a 1-year period, your portfolio could be up 20% or it could be down 20%. But as you stretch that timeline out, the probability of losing money shrinks dramatically. By committing to a minimum time horizon of 7 years, you are giving your money the runway it needs to weather the inevitable economic storms. You are bypassing the noise of quarterly earnings reports, the panic of temporary recessions, and the hype of whatever stock is trending on social media today. Imagine planting a mighty oak tree. You wouldn't dig up the seed every 3 weeks to see if the roots are growing, right? You plant it, you water it, and you leave it alone for years. That is exactly what the 7-year rule does for your money. It forces you to stop acting like a day trader and start acting like an owner. If you can't commit your capital for at least 7 years, it belongs in a high-yield savings account, not in your investment portfolio. Now that we have our timeline set, let's talk about the next number. The 5. This represents the 5 asset categories used for diversification. You've probably heard the old saying that you shouldn't put all your eggs in one basket. Well, the 5 asset categories are your different baskets. The specific categories can be tailored to your risk tolerance, but the crucial part is that they behave differently from one another. Let's walk through an example of what these 5 categories could look like in a standard, well-rounded portfolio. Category 1 might be large cap stocks, giving you ownership in the biggest, most stable companies in the world. Category 2 could be small cap stocks, which carry a bit more risk but offer higher growth potential. Category 3 might be international stocks, protecting you just in case your home country's economy takes a temporary downturn. Category 4 could be real estate, perhaps through real estate investment trusts, which provides a hedge against inflation and generates solid dividend income. Finally, Category 5 could be bonds or fixed income, acting as the shock absorber for your portfolio when the stock market gets incredibly bumpy. By spreading your money across 5 distinct asset categories, you ensure that even if one sector takes a massive hit, your entire net worth doesn't go down with the ship. It smooths out the ride. When real estate is down, maybe your international stocks are up. When the stock market crashes, your bonds hold their value. This diversification is the mechanical safety net that protects your hard-earned money from catastrophic loss. Next, we arrive at the most critical and often the most overlooked part of the entire framework. The 3. This stands for the 3 emotional phases that an investor must endure. Investing isn't just a math problem. It is mostly a psychology problem. The mechanics are simple, but keeping your head on straight when the world feels like it's ending is the true challenge. Phase 1 is excitement. This is when you first start investing. You've watched videos like this one, you've opened your brokerage account, and you've made your first deposit. You feel empowered. You calculate your future compound interest on a spreadsheet and imagine yourself retired retiring on a beach. But the excitement phase is fleeting. It usually only lasts until your first market correction or until you realize just how slow the wealth building process actually is. That leads directly into phase 2, which I like to call the slog. This is the hardest part. This phase is exactly why this psychological framework is designed to guarantee you survive the initial years of disappointing growth. During the slog, you might be investing consistently for 3, 4, or 5 years, and your portfolio barely looks any bigger than the actual cash you put into it. The market might be flat, or maybe it's down. You look at your friends who are seemingly getting rich overnight chasing fast money, and you start to doubt everything. You think, why am I doing this? Why am I sacrificing my current lifestyle to put money into a boring portfolio that isn't doing anything? Enduring this second phase is the ultimate test. It requires you to completely detach your emotions from your portfolio balance. If you can survive the slog, you eventually reach the explosion phase. This is the holy grail of investing. This is the point where the math of compound interest suddenly takes over. Your portfolio has grown large enough that an average 7 or 8% return equals more money than you could possibly save in a single year from your day job. Your money is now making more money than you are. The growth shifts from linear to exponential. But you can only experience the incredible joy of the explosion phase if you have the mental fortitude to push through the excitement and the slog. Finally, we reach the last piece of the puzzle. The 1. This stands for one annual contribution increase. We've established that this system relies on simple mechanics and math rather than motivation, discipline, or market timing. The one annual contribution increase is the mechanical lever that accelerates your entire timeline. Here's how it works in the real world. Let's say you start out by investing $300 a month. That's a fantastic start. But as you progress in your career, you'll likely get raises, promotions, or find ways to increase your income. If you allow your lifestyle to inflate at the exact same rate as your income, your wealth will stagnate. So you make a rule. Once a year, every single year, you increase your investing contribution. It doesn't have to be a massive jump. Maybe you increase it from $300 a month to $350 a month. The next year, you bump it to $400. By committing to just one annual contribution increase, you are fighting off lifestyle creep and mathematically ensuring that a larger portion of your income is constantly being put to work. It happens once a year, so it doesn't feel like a constant burden or a strict budget, but over the course of a decade, those incremental bumps create a massive tidal wave of capital flowing into your investments. When you put it all together, the 7-5-3-1 rule is the ultimate antidote to the chaotic, anxiety-inducing world of modern finance. You aren't constantly reading stock charts, you aren't trying to time the bottom of the market, and you certainly aren't risking your future on the latest crypto craze. You are letting your money sit for a minimum of 7 years. You are protecting it across 5 asset categories. You are psychologically prepared for the 3 emotional phases of the journey, and you are accelerating your wealth with one annual contribution increase. You are building a durable wealth-building system. It's incredibly boring, and that's exactly why it works. The quiet millionaires know that wealth isn't built by outsmarting everyone else. It's built by outlasting everyone else. So I want to hear from you. Which of the 3 emotional phases are you currently in right now? Are you in the initial excitement phase? Are you battling through the frustrating slog of disappointing growth? Or have you finally hit the explosion phase? Let me know down in the comments below. I read every single one. If you found value in this breakdown of the 7-5-3-1 rule, do me a favor and hit that like button, and make sure you subscribe to the channel so you never miss a strategy for building real, lasting wealth. Thank you so much for watching, keep sticking to the boring math, and I will see you in the next video.